Major changes are being made inside the banking system right now, and most people are not looking at them through the right lens. They are looking for one dramatic announcement. They are waiting for one law, one headline, one crisis, one moment when someone says, "Your money is no longer as free as you thought." That is not usually how systems change. In my experience, large systems rarely change all at once. They change in layers. A rule is adjusted, a reporting standard expands, a regulator adds a new interpretation, a bank changes its risk policy, a government gives itself another tool for the next crisis. Each change by itself looks manageable, but when you put them together, you see the pattern. And the pattern is that the modern banking system is becoming less flexible for the individual and more controllable for the institution. I do not say that to create fear. Fear is not useful unless it leads to better decisions. I say it because when the rules of the system change, the people who do not understand the rules become the weakest players in that system. They assume the old rules still protect them. They assume their bank is only a storage place for their money. They assume a deposit is the same thing as holding cash in their hand. They assume that if they have done nothing wrong, their money cannot be restricted. Those assumptions used to be closer to reality. They are less true today. There are a series of banking rule changes and banking practices that are causing concern among people who have meaningful cash, international exposure, or a need to move large amounts of money quickly. Some of these changes are already widely known, some are hidden in plain sight, some are not new laws, but they are being applied more aggressively because the system has changed. The question is not whether you should panic. You should not panic. The question is whether you understand the machine well enough to protect yourself from it. The first thing to understand is the difference between a bailout and a bail. And for most of modern financial history, when large banks got into trouble, the public expectation was simple. The government would step in, depositors would be protected, taxpayers would carry part of the burden. The official reason was stability. If people believed their deposits could disappear, they would rush to the banks, and a banking panic would make the crisis worse. That was the logic behind many interventions. But after the 2008 financial crisis, governments and regulators looked at the cost of bailing out banks and decided the model had to change. They did not want taxpayers to be seen as the first line of rescue every time a large financial institution made mistakes or suffered losses. So the system moved toward the bail. The word sounds technical, but the idea is simple. If a bank becomes insolvent or suffers severe losses, regulators can use resources inside the bank to stabilize it. The losses do not only come from the outside, they can be absorbed from within the capital structure of the bank. The order matters. First, shareholders are hit. Then debt holders and bondholders can be hit. And under certain conditions, large uninsured depositors can also become part of the loss absorbing layer. That is the part many people do not think about when you deposit money in a bank. You may think of yourself as someone storing money. But legally and structurally above the insured limit, you are also an unsecured creditor of the bank. That means the bank owes you money. And in a severe crisis, what you thought of as safe cash can become part of a resolution process. This is why deposit insurance limits matter. In the United States, the standard federal deposit insurance limit is $250,000 per depositor, per insured bank for each ownership category. In the European Union, it is generally 100,000 euros. In the United Kingdom, it is 85,000 pounds. In Canada, it is 100,000 Canadian dollars for eligible deposits. Everything above those limits needs to be understood differently. It may still be safe in normal conditions. But normal conditions are not the problem. The problem is what happens when stress enters the system. That is how I think about risk. I do not ask whether something works when the weather is good. Most systems work when the weather is good. I ask what happens when the weather turns. Liquidity tightens, confidence drops, and institutions begin protecting themselves. A bail-in is not a conspiracy theory. It is part of the legal and regulatory architecture in many developed countries. It exists because governments have tried to create a way to resolve bank failures without immediately putting taxpayers on the hook. You can agree with the policy or disagree with it. That is not the point. The point is that if you keep large uninsured balances at one bank and assume that those balances are identical to insured deposits, you are not seeing the system clearly. The second change is less dramatic, but it can affect many more ordinary people. It is the treatment of dormant accounts. Most people think that if they leave money in a bank account and do not touch it, the money simply waits for them. In many cases, that is not how the law works. If an account is inactive for long enough, it can be classified as dormant. Once it is classified that way, unclaimed property rules can apply. Those rules can allow the money or financial asset to be transferred to the state. In some places, the dormancy period can be as short as 3 to 5 years. That is not a long time in a lifetime. A person might open an account, move, become ill, forget about it, pass responsibility to a family member, or lose track of paperwork. A business owner might keep an old account for emergencies and not use it for several years. A retiree might have small accounts scattered across institutions. In the old world, forgetting about an account felt like an inconvenience. In the new world, it can create a legal process. Usually there is a way to reclaim the money after it is transferred, but that process can be slow, bureaucratic, and difficult, especially for heirs who may not know where the funds were held or what records exist. The concern is not only that these rules exist, the concern is that dormancy rules are changing and in some jurisdictions becoming more aggressive. Australia shortened the dormancy period for many financial assets from 7 years to 3 years. The United Kingdom expanded its dormant asset scheme beyond ordinary bank accounts into other kinds of assets, including investments and insurance balances in the European Union. Policymakers have discussed harmonizing dormancy rules across member states, which could pull systems toward a lower common threshold that matters because property rights are not only about whether you own something in theory, they are about how many steps stand between you and losing practical control over it. There are jurisdictions that treat dormant assets differently. Switzerland has historically required banks to make extensive efforts to find you or your heirs before assets are transferred. Liechtenstein has a reputation for maintaining funds for much longer without transferring them to the government. Monaco has its own approach with longer windows than many other developed systems. The point is not that everyone should run to another country. The point is that different systems create different protections. When I look at money, I do not just look at return. I look at custody. I look at jurisdiction. I look at the rules around access. I look at what happens if something goes wrong, if the owner becomes ill, if the heirs are not informed, or if the institution changes its policy. Ownership without access is fragile. Access without documentation is fragile. And money held in a jurisdiction you do not understand is more fragile than most people realize. The third change is civil asset forfeiture. This is one of the clearest examples of a system that can affect people long before guilt or innocence is finally determined. Most people believe assets can only be taken after a criminal conviction. That belief is incomplete. In many developed countries, authorities have legal tools that allow them to freeze or seize assets without first obtaining a criminal conviction. In the United States, civil asset forfeiture is used under federal and state law. In the United Kingdom, authorities can use unexplained wealth orders. Australia and Canada have similar proceeds of crime systems. These tools were originally designed to target organized crime, corruption, money laundering, and other serious wrongdoing. The problem is not the stated intention. The problem is the threshold at which assets can be frozen and the time it can take to get them released. If an account is frozen during an investigation, the money may still legally belong to you, but practically you may not be able to use it. That distinction matters if you need the money for payroll, medical care, taxes, legal expenses, a property purchase, a family emergency, or business operations. Being told that ownership will be sorted out later may not help you. In a well-functioning system, there should be a careful balance between preventing crime and protecting innocent owners. But in any large bureaucratic system, there are incentives. Institutions prefer not to be blamed for letting suspicious money move. Regulators prefer to appear tough. Banks prefer to over-report rather than under-report. And once an account is frozen, the individual often carries the burden of delay. This is why resilient people do not build their financial lives around a single point of failure. If one account, one bank, one country, or one payment rail controls your access to everything, you are fragile. The wealthier and more sophisticated families I have observed think differently. They do not ask, where can I get the highest yield this month? First, they ask, where is my money most resilient under stress? Where are the rules clear? Where are property rights respected? Where would a dispute be handled carefully rather than automatically? That does not mean hiding assets. That does not mean avoiding taxes. That does not mean breaking reporting rules. It means understanding that legal access to money can be disrupted, and that a thoughtful banking structure can reduce the damage if one institution or one jurisdiction becomes difficult. The fourth change is capital controls. People often think capital controls are something that happen only in developing economies. That is another dangerous assumption. Capital controls are restrictions placed on moving money out of a country, converting money into foreign currency. Withdrawing cash or sending funds abroad, they are usually introduced during severe stress, when a government fears that money is leaving too quickly and the financial system may destabilize. In theory, your money still exists. In practice, you may not be able to move it. That is the difference between accounting wealth and usable wealth. Cyprus imposed withdrawal limits and restricted international transfers during its banking crisis. In 2013, Greece capped ATM withdrawals during its debt crisis. Iceland maintained strict capital controls for years after its banking collapse. These were not ancient events in failed states. They were modern financial systems under stress. When capital controls arrive, they usually arrive quickly. The point of a capital control is to stop movement before people can react. If a government announces that capital controls may come in 30 days, the capital leaves in 29. So controls tend to be imposed suddenly under emergency logic with the argument that they are temporary and necessary. Sometimes they are temporary. Sometimes temporary lasts longer than people expect. The lesson is simple. The time to build optionality is before you need it. If all of your money is held in your home country in your home currency inside one domestic banking system, then when that system imposes restrictions, your choices shrink immediately. If some portion of your liquidity is already held in a strong and stable jurisdiction abroad, and held legally, transparently, and with proper reporting, you may have more flexibility. You may be able to move, invest, support family, pay expenses, or operate internationally even when your home country tightens access. This is not about predicting collapse. Good risk management is not based on certainty. It is based on probability, consequence, and diversification. If an event has low probability but high consequence, and if the cost of preparing is reasonable, preparation can be rational. That is how I think about capital controls. You do not prepare because you know they will happen. You prepare because once they happen, preparation is no longer available. The fifth change is investment and asset restriction. This is subtler than capital controls, but it follows a similar pattern. Governments and regulators are increasingly shaping what citizens can hold, how they can hold it, and how much exposure they can have to certain assets. Sometimes the reason is tax enforcement. Sometimes it is financial stability. Sometimes it is anti-money laundering policy. Sometimes it is consumer protection. The reasons may be legitimate, but the effect is still that the range of personal financial freedom can become narrower. In the United States, investors face complicated tax rules when holding certain foreign mutual funds. In the United Kingdom, there have been proposals around limits on stablecoin exposure around the world. Regulators are increasing scrutiny of crypto holdings, foreign currency accounts, gold transactions, and cross-border assets through reporting requirements. These rules can influence behavior. If a government makes an asset difficult to own, expensive to report, or risky from a compliance standpoint, many ordinary people simply avoid it. That may be the intended effect. The danger is that people confuse legal permission with practical freedom. You may be legally allowed to diversify internationally, but if the paperwork is confusing, the tax rules are punitive, the reporting requirements are severe, and the banks become uncomfortable servicing you, then in practical terms, your choices are constrained. This is why rules matter. A portfolio is not just a list of assets. It is also a list of jurisdictions, counterparties, tax obligations, reporting systems, and access rules. When you own assets, you should ask 3 questions. Can I legally own this? Can I practically access it when I need it? And can I explain it clearly to my bank, my tax authority, my heirs, and my advisors? If the answer to any of those questions is weak, the asset may be more fragile than it looks. The 6th change is currency debasement and the possible future role of central bank digital currencies. Currency debasement is not mysterious. It happens when the supply of money grows faster than the productive capacity of the economy, causing purchasing power to decline over time. If inflation runs higher than the interest you receive on deposits, then your bank balance may look stable, but your real wealth is falling. This is one of the most misunderstood risks in money. People fear losing dollars. They do not always notice losing purchasing power. But purchasing power is what matters. The purpose of money is not to sit as a number on a screen. The purpose of money is to buy goods, services, assets, freedom, time, and security. If you keep money in a bank account yielding less than inflation, you are paying a hidden tax. It does not come as a bill. It comes as a slow reduction in what your money can do for you. At the same time, many central banks are exploring central bank digital currencies, or CBDCs. CBDCs are digital national currencies issued directly or indirectly through central bank systems. The technology and structure vary by country, and the future use is still debated. But the reason wealthy people pay attention to them is that they could introduce monetary tools that are harder to implement in a cash-based system. Programmable money, spending restrictions, targeted stimulus, negative interest rates, demographic or geographic controls. Again, the important point is not to claim that all of these things will happen. The important point is that the architecture can allow possibilities that did not exist in the same way before. When a system gives itself new tools, you must consider not only how good people say the tools will be used, but how they could be used during stress, political pressure, inflation, social unrest, or financial crisis. That is how I think about systems. You do not judge a system only by the intentions of the people currently operating it. You judge it by its design, its incentives, and what it permits future operators to do. CBDCs remain uncertain in their final form. But uncertainty is itself a reason to diversify, especially if you are holding all of your liquidity in one currency and one banking system. The seventh change is the growing power of tax authorities to freeze or pursue accounts across borders. Every developed country has mechanisms that allow tax agencies to freeze bank accounts in certain circumstances, usually when taxes are unpaid, disputed, or under investigation. International agreements like FATCA and information sharing treaties have made cross-border financial visibility much greater than it used to be. For law-abiding people, the issue is not whether taxes should be paid, they should be paid. The issue is how aggressive the process can become and how easily an account can be restricted while an investigation is still underway. Many people with international lives, businesses, investments, or family obligations are not trying to hide anything they file. They report, they comply, but they still worry that a tax authority may freeze or challenge assets while trying to understand complex cross-border activity. The more international your life becomes, the more important documentation becomes. Tax residency, source of funds, purpose of transfers, beneficial ownership, account signers, entity structures, gift records, loan agreements, investment statements. These things seem boring until you need them. Then they become the difference between a short conversation and a long freeze. Certain jurisdictions require more formal court processes before enforcing foreign tax claims. Some require specific treaty provisions and documented evidence before accepting a claim. Other systems respond more quickly to foreign requests. That difference matters. Again, this is not about escaping lawful obligations. It is about making sure that if you are doing things legally, your money is not easily trapped by confusion, bureaucracy, or overreach. The eighth change is transaction monitoring. This is something most people experience without realizing it. Every modern bank operates under anti-money laundering requirements. Banks monitor customer activity. They look for unusual transfers, large withdrawals, international wires, rapid movement of funds, links to certain countries, cash activity, crypto-related activity, and patterns that differ from a customer's historical behavior. In the United States, suspicious activity reports can be filed. Canada reports through FinTrack. Australia has AUSTRAC. The United Kingdom and the European Union have similar monitoring frameworks. The important point is that transactions below formal reporting thresholds can still trigger monitoring. Many people believe that if a transfer is below $10,000, nothing is noticed. That belief is false. The old world was more threshold-based. The new world is more behavior-based. Banks are moving toward artificial intelligence, pattern recognition, and shared risk information. The question is not only, did this transaction cross a formal threshold? The question is, does this behavior look different? Does it fit this customer profile? Does it resemble a known risk pattern? Has another institution flagged something related? This changes the nature of privacy and access. A perfectly legal transaction can trigger a review because it looks unusual. A large cash withdrawal can trigger a review. A foreign wire can trigger a review. A transfer to a new counterparty can trigger a review. A crypto-related transaction can trigger a review. A change in behavior can trigger a review. And once a review begins, the customer may not know exactly what is happening. The bank may say the transfer is under compliance review. The bank may ask for documents. The bank may delay the transaction. In some cases, the account may be temporarily frozen for people who need large amounts of money to move reliably. That uncertainty is a real risk. If you are selling a business, buying property, paying an international supplier, supporting family abroad, or moving capital between investments, you cannot build your life around hoping that a compliance department is comfortable. This is why fit matters. A bank that is designed for small domestic retail accounts may not be comfortable with large international transfers. A bank that serves wealthy families, international investors, and cross-border clients may be much more accustomed to that activity. The issue is not only where you bank, it is whether the bank understands your profile, If your activity looks unusual to the bank, you are more likely to be treated as unusual by the bank. The next practical change is what happens when monitoring turns into an account freeze. This is not always described as a separate rule, but in real life it is one of the most important consequences. A transaction review can become an account restriction. An account restriction can prevent you from sending wires, withdrawing money, converting currency, or accessing funds while the bank completes its investigation. In many cases, no wrongdoing has occurred, but the individual still loses time. And in finance, time is not neutral. A delayed payment can break a property transaction. A delayed wire can damage a business relationship. A delayed withdrawal can create a medical or family problem. A delayed currency conversion can expose you to exchange rate movement. A delayed account release can force you to sell other assets at the wrong time. This is why I always come back to one principle. Do not allow one system to be the only path between you and your own money. Redundancy is not inefficiency when the system is fragile. It is protection. The 10th change is de-risking. Banks sometimes close accounts not because the client has done anything wrong, but because the bank believes the client presents too much risk, too much complexity, or too much compliance cost. This is called de-risking. It can happen to people with large international transfers. It can happen to people connected to cryptocurrency businesses. It can happen to politically exposed persons. It can happen to clients connected with certain countries. It can happen to entrepreneurs and industries the bank no longer wants to service. It can happen to people whose activities are legal but inconvenient. Instead of investigating and understanding the client, the bank chooses the simpler path. It exits the relationship from the bank's perspective. This can be rational. Compliance risk is expensive. Regulatory penalties are large. A small number of complicated clients may not be worth the trouble. From the customer's perspective, it can feel arbitrary and destabilizing. Imagine running a legal business and being told that your account will be closed in 30 days. Imagine holding international assets and being told your bank no longer wants to process your transfers. Imagine depending on a bank relationship and discovering that the bank's risk model has changed. This is another reason why banking should be matched to profile. If you are a simple domestic customer with predictable payroll deposits and ordinary spending, almost any mainstream bank may work. If you are wealthy, international, entrepreneurial, politically exposed, connected to high-risk industries, or regularly moving large sums, you need a banking relationship that was designed for that level of complexity. Trying to force a complex financial life into a cookie-cutter retail banking model creates friction. And under stress, friction becomes restriction. The final change is the growing restriction of physical cash. This is especially visible in parts of Europe, where countries such as France, Spain, Greece, and the Netherlands have rolled out restrictions on large cash payments. In other places, the law may not fully ban cash, but banks, merchants, and payment providers make it harder to use in practice. The result is the same: cash becomes less usable. This matters because cash is not just a payment method. It is also a form of privacy, independence, and resilience. A society does need tools to fight tax evasion, crime, and money laundering. But when cash is restricted too aggressively, ordinary people lose an important backup system. If every payment must pass through a digital rail, then every payment can be monitored, delayed, blocked, categorized, or analyzed. That may be efficient. It may also be fragile. Physical cash has limitations. It can be stolen. It does not earn interest. It is not practical for large international transfers. But it gives individuals a way to transact when systems fail, when networks go down, when banks are closed, or when digital rails malfunction. When cash becomes difficult to use, people become more dependent on the institutions that control digital payments. That is the broader pattern. Bail-ins make large uninsured deposits less absolute. Dormant account rules make inactive ownership less passive. Civil forfeiture makes access vulnerable before final judgment. Capital controls can trap money inside a country. Asset restrictions shape what people can own. Currency debasement reduces purchasing power over time. CBDCs may create new tools for monetary control. Tax authorities have more cross-border reach. Transaction monitoring is becoming faster and more behavioral. Compliance freezes can delay access even without wrongdoing. De-risking can close accounts because a client is inconvenient. Cash restrictions reduce the ability to transact outside the digital system. Each change is different, but together they point in one direction. The system is moving toward more control, more monitoring, more automation, more institutional discretion, and less tolerance for individual financial complexity. The answer is not paranoia, the answer is structure. If I were helping someone think through this, I would begin with very basic principles. Know where your deposits are held and how much is insured. Do not keep all meaningful liquidity above insurance limits at a single institution. Keep accounts active enough that they cannot be classified as forgotten or abandoned. Maintain clean documentation for large transfers, international movement, asset sales, inheritance, business income, and family support. Use banks that match your profile instead of forcing your profile into a bank that does not understand it. Maintain more than one banking relationship. Consider legal, transparent international diversification if your life, assets, or risks justify it. Understand tax reporting before moving money abroad. Do not confuse diversification with secrecy. Do not confuse access with ownership, and do not wait for a crisis to build the rails you might need during a crisis. The most important lesson is that the banking system is not simply a neutral vault. It is a network of laws, incentives, regulators, risk models, reporting duties, and institutional decisions. Your money sits inside that network. When the network is calm, you may not notice it. You log in, see a balance, send a payment, and assume everything is under your control. But when the network becomes stressed, the rules reveal themselves. Then the difference between someone who prepared and someone who assumed becomes very large. This is true in markets. It is true in geopolitics. It is true in debt cycles, and it is true in banking. People usually lose control slowly. Then suddenly they ignore the small signs because each one seems too minor to change behavior. Then one day they need to move money, access cash, send a wire, support a family member, protect a business, or respond to a crisis. And they discover that the system has more power over their money than they realized. That is the moment I want you to avoid. You do not need to be afraid of banks. You need to understand them. You do not need to flee your country. You need to understand jurisdiction. You do not need to abandon cash, deposits, or digital payments. You need to understand the trade-offs. You do not need to make extreme moves. You need to remove single points of failure. That is the principle. A resilient financial life is not built on one bank, one currency, one country, one payment method, one account, one assumption, or one rule that you hope never changes. It is built on diversification, documentation, legal compliance, liquidity, and access. When I study cycles, I see the same pattern again and again. Systems become more complex. People assume complexity means safety, then stress arrives. And complexity becomes confusion. The people with clear structures survive better than the people with everything tied together in one place. That is why you must think before the crisis. You must ask, what happens if my bank fails? What happens if my uninsured deposits are above the limit? What happens if my account is marked dormant? What happens if a transaction is reviewed? What happens if a wire is delayed? What happens if my bank exits my relationship? What happens if my home country restricts capital movement? What happens if my currency loses purchasing power faster than my deposits earn interest? What happens if my heirs need to find and access accounts after I am gone? These are not dramatic questions, they are practical questions, and practical questions lead to practical protection. The people who are best protected are not the ones who predict the future perfectly. Nobody does that. They are the ones who understand the range of possible outcomes and build systems that can handle more than one of them. That is what this is really about. It is about seeing that the rules of banking are not fixed forever. It is about seeing that access to money is a risk variable. It is about seeing that the person who owns capital but cannot move it at the moment it matters is not as secure as they thought. And it is about taking reasonable steps now while conditions are calm so that you are not forced to make emotional decisions later. Because when a banking rule changes, when a government imposes controls, when a bank freezes an account, when a compliance department delays a transfer, or when an institution decides you are outside its risk appetite, the time to prepare has already passed. The goal is not to beat the system. The goal is to understand the system well enough that it does not trap you. That is how I would think about the new banking rules. Not emotionally, not politically, not with panic, with principles, with probabilities, with preparation, and with the understanding that in a world where rules keep changing quietly, the most dangerous position is not having money in the bank. The most dangerous position is assuming that money in the bank is always fully under your control.